Hello class, and welcome to the video lecture for analyzing financial statements. The last learning unit covers 4 types of financial ratios commonly used in financial statement analysis. Those are liquidity ratios, asset management ratios, debt management ratios, and profitability ratios. Liquidity ratios measure a company's ability to meet short-term obligations, which are short-term liabilities. The most common liquidity ratios are called the current ratio and the acid test ratio. Both ratios measure a company's ability to pay off short-term debt such as accounts payable or notes payable. Asset management ratios measure how effectively a company is using its assets. Debt management ratios measure how well a company is using debt versus its equity position. This has to do with raising funds. Issuing bonds is an example of debt, and issuing stock is an example of equity. Profitability ratios measure a company's ability to earn profits. Let's look at the liquidity ratio called the current ratio first. The formula for the current ratio is simply current assets divided by current liabilities. The textbook on page 769 uses the example of Scrupper Company. Scrupper's current assets are $48,000 and current liabilities are $21,200. This information comes from the balance sheet. In this example, we get 2.26. The conventional way of writing this ratio is to write it as 2.26 followed by a colon followed by a 1. This means for every dollar of short-term liability, the company has 2.26 in assets that could potentially be used to pay the liability. Whether that's good or bad depends upon what the ratio is compared with and the industry. For example, if the current ratio of other companies similar to Scrupper is 1:1 and Scrupper is 2.26:1, you could say Scrupper is more liquid than similar companies. Maybe it's a good thing, since Scrupper can pay its bills easier than the other companies. Maybe it's a bad thing if Scrupper is holding too much cash or inventory. Financial ratios are to be used in comparison. The acid test ratio is a special kind of liquidity ratio. It's the same as the current ratio, except instead of all current assets, we only use those current assets that can be easily converted to cash. Assets that can be easily converted to cash are short-term investments, such as bank certificates of deposit, and accounts receivable, which can be sold to a company called a factor. A factor will take a company's accounts receivables and attempt to collect the money from the customers. In return, the factor gives the company money. You might be familiar with them when they're called collection agencies. Here's an example. Instead of total current assets, the acid test ratio uses current assets minus inventory minus prepaid expenses. That's because inventory and prepaid expenses, while still considered current assets, can't be exchanged for cash all that quickly. We're given the amount for Scrupper Company as $23,040. So our ratio is 1.09:1. Remember that the quick ratio was 2.26:1. Now it's nearly 1:1. This means Scrupper can still pay its current liabilities, but aren't quite as liquid as we may have originally thought. Again, this number isn't good or bad. Now let's move on to asset management ratios. The first one is the accounts receivable turnover ratio. It shows how many times in a year accounts receivable is turned into cash. It has to do with how long a company gives its credit customers to pay. The formula is net credit sales divided by the average accounts receivable. In the textbook example, accounts receivable at the end of 2012 was $16,000, and at the end of 2013 it was $20,000. If you take those two numbers and divide it by 2, you arrive at $18,000, which is the average accounts receivable. We're given the information in the textbook that net credit sales is $317,600. So we divide that by the average of 18,000 to get 17.6. This means it turned accounts receivable into cash 17.6 times in 1 year. Whether or not this is good depends upon what it's compared to. For example, if the companies like Scrupper have an accounts receivable turnover of 25, it doesn't seem like Scrupper's customers pay as quickly as other companies' customers. Maybe Scrupper is giving them too long to pay. The next ratio is called the average collection period. It shows how quickly a company collects payment from its customers. The formula is 365 days divided by the accounts receivable turnover, which we calculated in the previous slide. In this example of Scrupper, we arrive at 20.7. Inventory turnover is a ratio that measures how quickly inventory is sold. The formula is cost of goods sold divided by average inventory. In this example, we're given cost of goods sold as $198,000. Average inventory is computed as the beginning balance of inventory plus the ending balance of inventory divided by 2. We arrive at an inventory turnover of 7.9. Just like the average collection period, this ratio is in terms of days, so this means it takes Scrupper an average of 7.9 days to sell an item in inventory. The asset turnover ratio indicates how efficiently a company uses its assets to generate sales. The formula is net sales divided by total assets. In this example, we arrive at 1.8. This number should be compared with other companies in the same industry, or perhaps Scrupper's own asset turnover ratio from previous years in order to have meaning. Now we move on to debt management ratios. The first is debt to total assets ratio. This ratio measures how much of a company's assets are financed by debt. The formula is total liabilities divided by total assets. In this example, we arrive at 46.9% of assets are financed by debt. Debt to stockholders' equity is a ratio that measures the risk of creditors in relation to the risk of stockholders. It's computed by taking total liabilities and dividing it by total stockholders' equity. This ratio is best used in comparison to other similar companies. In this example, we arrive at 88.3%. Next, we have the ratio called times interest earned. It measures how well a company can make its interest payments, which is important to creditors. It's calculated as net income before any tax or interest expense divided by the total interest expense. In this example, we arrive at 8.6 times. This means the company has 8.6 times the net income it needs to cover its interest expense. Now we move to profitability ratios. First, we have the gross profit rate ratio. It's calculated as the gross profit, which is sales minus cost of goods sold, all divided by net sales. In this example, we have 37.7%. If we round that to 38%, we can say that for each dollar of sales, 38 cents is profit. That also means for every dollar of sales, 62 cents is cost of goods sold. Next, we have the return on sales ratio. It's calculated as net income before taxes divided by net sales. In this example, we arrive at 10%. This is another ratio that's best compared with other companies within the same industry. If the percentage is higher than other companies, it indicates the operating expenses are lower than other companies. If the percentage is lower, it means the opposite, and operating expenses are higher than other companies. Here we have the rate of return on total assets. It's calculated as net income before interest and taxes, all divided by total assets. In this example, we arrive at 20.8%. If this number is compared with other companies in the same industry, it can indicate how well the company is using its assets to make profit compared to other companies. This slide shows another way to calculate rate of return on assets. The calculation can use other ratios, such as return on sales and total asset turnover, to arrive at the same amount. Finally, we have rate of return on common stockholders' equity. It's calculated as net income before taxes minus preferred dividends, all divided by common stockholders' equity. In this example, we arrive at 34.6%. This number can indicate the use of debt financing versus equity financing in comparison with other companies. If the company has a lot of debt, interest expense will make net income lower and thus make rate of return on common stockholders lower. If the company has very little debt, net income will be higher and thus rate of return on common stockholders' equity will be higher. Debt financing versus equity financing both have their pros and cons, so having a low or high rate of return on equity isn't necessarily good or bad. It must be compared with other companies. Here we have part of the list of ratios from the textbook. This list is printed on page 775. When doing your homework, it's best to have this page handy. You don't need to memorize the formulas. For this chapter, please focus on the key terms and be familiar with the 4 major categories of ratios. These categories are the ones we just went through, and they're also listed on page 769. That wraps up Chapter 22. I'm not going to go through any of the problems for this chapter because they all only require computations, which I know you can do using the calculator. And this also wraps up the quarter. So good luck on the final exam, which covers chapters 18 through 22, and I wish you the best of luck in all your future endeavors.